Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're discussing rollover options for your old 401k plan.
Okay.
If you've left behind a 401k or a few 401ks with a past employer or past employers, you're going to want to watch this video to the end because making the wrong rollover move may end up costing you a lot more than you bargained for. And as a result, it chips away at the retirement savings that you thought you had, you know? And I get it. Like changing jobs is a busy time for people. And that's the last thing anyone is thinking about when it comes to like new job, right? Like, oh yeah, what should I do with that old 401k? Not happening. But here's the thing. You worked hard to save for this money. Don't just let it sit. You want this money to work for you. And that means rolling it over into a new financial vehicle and not leaving it just to rot.
Right. And there's a huge misconception out there, Michelle, that past employers will handle your 401k for you. Legally, they can't. It's your money and your responsibility to manage your retirement savings. So,
amen to that. All right. So on that note, before we dive in and cover these rollover options, let's start with the types of rollovers. So there's two types of rollovers. There's the direct and there's the indirect. Can you just quickly take us through those because people need to understand that before we get into the options?
Exactly. Okay. So understand this is critical because it can cost you if you mess this up. Okay. Right. So the first is an indirect rollover. With this type of 401k rollover, you actually receive a distribution from your retirement plan. And then to complete the rollover transaction, Michelle, you make a deposit into the new retirement plan that you want to receive the funds. Okay. You can make that a rollover at any age, but there are specific rules that must be followed. You must complete this rollover within 60 days of the funds being paid to you. Okay. If it's completed properly, indirect rollovers aren't subject to an income tax. But if you fail to complete the rollover or you miss that 60-day deadline, all or part of your distribution may be taxed and subject to a 10% early withdrawal penalty unless you're over age 59 and a half. Okay. And
ouch.
Yeah, ouch. Also, though, if you receive a distribution from your employer retirement plan, your employer must withhold 20% of the payment for income taxes. Okay, so after taxes are taken out, you'll be sent their funds by a check. The problem with that is, Michelle, guess what? When you're doing the 60-day rollover, you have to be able to come up with that 20% withheld to be able to complete the whole transaction, or you're going to get hit with taxes and penalty on that extra 20%.
And you get the money back the following tax year. It's just you have to make up that difference in the meantime in that 60 days. Otherwise.
Yeah, exactly. And the second way is the direct rollover. Okay. A 401k direct rollover occurs directly between the trustee or custodian of your old retirement plan and the trustee of your new plan. It's that simple. You never actually receive the funds, have no control over them. So a trustee to trustee distribution it's not treated as a distribution.
There's no worried about that 20%, make 20% taxes, a 60-day deadline, nothing.
Exactly. You're good.
All right. All right. So before we get to the 401k rollover option, oh, wow, that's a mouthful. Before we get to the 401k rollover options, there we go. If you like the content of this video, hit that like button, help us grow the channel, and don't forget to subscribe.
Exactly.
All right, Brian, let's hit it. What are the 4 options people have?
Okay. You can roll over your traditional 401k plan to a traditional IRA.
Okay.
So most people have traditional 401k plans. So the transfer is simple. Since those contributions were also made pre-tax, you just roll it right over to a traditional IRA. Okay. No new taxes are due when the money's roll over. New earnings will accumulate in your IRA, still tax deferred. Your required minimum distributions must start at age 72, which is bumped up from 70 and a half thanks to the Secure Act, and very well could be up to age 75 if Secure Act 2.0 passes. 2.0. Make sure you check out that video we did. So.
All right. So what's the second option?
Second option, roll over your traditional 401k to a Roth IRA.
Okay.
we see this very common. If your traditional 401k allows direct rollovers to Roth IRA, you can roll it into a new or an existing Roth IRA.
So real quick on that note, Brian, you have to know, I mean, this is if you said if your traditional 401k allows it.
Right.
So it's not always allowed. It depends
Not
on
always
your
allowed.
plan. Okay.
Yeah. Well, it depends on the plan, what your options, rollover options are. Make sure you read the fine print of the rollover options of your previous employer. So,
Okay.
but if you do roll it over to a Roth, you're going to have to pay taxes on the rollover amount. Okay.
Right.
But earnings that accumulate after the rollover is going to be eligible for tax-free withdrawal when you're at least 59 and a half and the Roth IRA has been open for at least 5 years. Required minimum distributions for Roth IRAs, they're same as the traditional, but you must take RMD starting at age 72.
Sure.
Yeah,
Okay.
here's another thing on that same subject. If you have both a traditional 401k and a Roth 401k provision, then you'll need to set up 2 separate IRAs, a traditional IRA and a Roth IRA.
Roth. So the traditional 401k goes in the traditional IRA and the Roth
Right.
provision of your 401k goes in a Roth IRA.
Which we see that very often, Michelle, because of the fact that they don't want to put everything into the Roth and pay all them taxes in one tax year.
I get that. I get that. Okay. What's the third option?
Roll your Roth 401k to a Roth IRA. Pretty simple.
Okay.
Keep it at the same as what it was. No taxes due when you convert the accounts, and all your new earnings still continue to accumulate tax deferred. So,
okay. All right. And the fourth and last option.
yeah, we see this one quite often. Roll your 401k to an annuity.
Mm-hmm.
Many financial advisors are recommending annuities because your investment still grows on a tax deferred basis and you pay no income tax on the gains until they're ready to be withdrawn. Okay. However, rolling over your 401k to annuity offers no additional tax benefits as your money is already tax deferred. Okay.
Right.
But here's the scenario. Annuities are becoming attractive because they guarantee income for life.
Yeah.
Okay. But some of them also come with hefty fees. That's why it's critical to read the fine print of the contract.
Read the contract.
Yes, we always say that. Should you decide to roll over to an annuity. So also, some annuity plans have the option of paying you for life and then transferring the remainder of the contract to your spouse if you die first. Others
Right.
do not allow you to pass on the remainder to your beneficiaries. So,
Okay. And that's it pretty much, right?
that's it.
Before we wrap up, there is one thing. If you've watched to this point, if you're going to be doing a 401k rollover anytime soon, there is a new law that went into effect. It's officially in effect July 1st of 2022. It's called the DOL rule. And we did a video on this. It's below. But basically, Brian, I'm going to give it over to you. Tell us in a nutshell what it says and what consumers need to be on the lookout for as they're looking to roll over.
Here's the scenario. No matter where you plan on taking your funds, unless you're doing it yourself, the DOL rule has no play here. But if you're doing it with any type of advisor or firm out there today, your advisor or firm must now disclose to you in advance before the rollover of any conflicts of interest.
Yeah.
What they're going to be paid and what type of relationship you and them will have on an ongoing basis. Okay. They must put your interest ahead of their own.
Right.
Pretty simple.
And disclose. They have
everything's disclosed and you,
why
the
they
consumer,
chose
has
what they
to sign.
Yeah, absolutely. All right. So if you're not asked that, when it comes time to roll over, you may want to look for an advisor who will follow the law.
Exactly.
All right. On that note, if you like the content of this video, hit that like button, help us grow this channel. Don't forget to subscribe and do check out that new DOL rule video below and the other videos we mentioned. We have quite a few on 401ks that you should check out. Thanks everybody for watching, and thanks, Brian.
Thanks, Michelle. Thanks, everyone. Have a great day.